Hello, I'm Will Dunn. I'm the business editor at the New Statesman, and today I'm joined by Duncan Weldon, who's written our latest cover feature, Britain on the Brink, about the economic situation into which Britain is heading. Duncan, start by telling us a little bit about the position that households are in. So you describe a situation in which basically people are kind of trapped between the government and the Bank of England. Is that fair to say?
Yeah, I mean, I think if we go back to August, when the Bank of England released its previous set of forecasts, I think, the reaction of myself, of many observers looking, was to say these are the grimmest set of Bank of England forecasts, at least since independence, the grimmest in a few decades. And then the new forecasts that accompany that interest rate rise are, if anything, even worse. We're in this unprecedented squeeze in living standards. We've got inflation sort of running in the double digits, really high energy bills, wage growth only half as much as inflation, so people are really being squeezed. And then on top of that, we've got the Bank of England putting up interest rates, adding to borrowing costs, mortgage costs. And now it seems like we're heading for the government sort of, doubling down in the same direction with tax rises and spending cuts. So it's one of those situations when just about everything that could be going wrong is going wrong at the same time.
Let's start with the Bank of England. Why is the Bank of England making it more expensive to borrow money at exactly the point when people's disposable income is under so much pressure?
Yeah, and we should, emphasise this is, unusual in recent experience. The last couple of downturns, sort of the pandemic 2020 and the banking crisis 2008, 2009, as Britain went into recession, the bank was cutting interest rates rather than increasing them. The difference this time is that inflation is about 10%. The Bank of England's target is 2%. It's 5 times that high. The bank wants to get inflation back to 2% in the medium term, and they think that requires tighter policy. And we should be clear, lots of that high inflation is because of energy bills, because of global food prices, because of disrupted supply chains after the pandemic, these global factors. You can accuse the Bank of England of many things. You can't accuse them of being utter morons. They understand that putting up interest rates won't bring down energy prices. What worries the bank is that if you look at core inflation, that's if you strip out food, you strip out energy prices, sort of domestically generate inflation, that's at a 30-year high, about 6.5% or so. And the bank thinks that's because we've got this very tight jobs market, we've got domestic inflationary pressures, and the bank thinks to hit its target, it needs to slow the economy, slow demand, relieve some of that pressure. So, as I put in the piece, what the bank is trying to do is to raise borrowing costs, slow corporate hiring plans, slow spending, and that's a feature, not a bug. It's what the bank is trying to do, painful as it is.
Yeah. So the bank has to inflict pain on consumers, on people in the economy, right? I mean, what happens if it doesn't?
We can talk about whether the bank's right or not, but the bank worries that if it doesn't do that, inflation will stay well above its target, not just this year and next year, but in the future. And in the pain of increasing interest rates, it's a real pain. In the bank's view, it's inflicting short-term pain now for sort of the longer-term good of the British economy. And that, people's mortgage bills going up is painful, but if inflation is to be, if inflation was to be 5, 6, 7% rather than 2%, in the future, that's also painful for people. So it's what type of pain, how you take that pain and when you take that pain. And the bank's target is to bring inflation back down.
Do you think that's the right move at this point?
I think I worry when I look at the bank's forecasts, grim as they are, that they're being overly optimistic in a few areas. I mean, I suspect, given what's happening to household incomes, that we're going to see a really big fall in discretionary spending. And I think that will impact quite quickly the jobs market. So, at the moment, we've got more job vacancies than unemployed workers, which is really, really, really unusual. But I strongly suspect as the economy contracts, corporate hiring plans will be scaled back really quite quickly. So, I think this tight jobs market could loosen, I think, which much faster than the bank expects it to. Actually, the really interesting thing, I think, almost hidden behind all of this, is sort of financial markets sort of expect the Bank of England's base rate to rise from about 3% today to something more like 5% plus next summer. The bank very clearly thinks financial markets are overestimating how much tightening there's going to have to be. So, the bank, the governor, the deputy governor, all of these recent speeches have sort of been guiding away, saying, look, yes, rates are going to go up, but they're probably not going to go up that much.
On the, that sort of that tipping point that the bank could create, is it fair to say also that the UK not only it has a tight jobs market, but it has quite a precarious jobs market? So we're in a situation where there are lots of people on short contracts, on 0 hours contracts, employed in the gig economy, who their situation could change a lot more suddenly than in previous decades, right?
Yeah, I think that's completely right. Britain's got sort of a very flexible, very small L liberal jobs market. It's very easy to hire. It's very easy to fire. And sometimes that it being very easy to hire is helpful. But the danger is in a downturn, it being very easy to fire. The bank expects unemployment to rise for the next couple of years. I mean, it could easily rise faster than the bank is expecting. I mean, the other thing is on labour supply. We know one trend driving this sort of imbalance between vacancies and unemployed workers is that an awful lot of people, it seems, towards the end of the pandemic, basically didn't come back from furlough. They reassessed their life. They're particularly men in their late 50s, early 60s, retired earlier than planned. And I do wonder if next year one thing we will see is, I don't even know what the word is, unretirement. People who, people who made the decision to stop working at 60, 61, probably weren't expecting inflation to be 10%. But I think, okay, maybe my pot of savings isn't what I thought it was. Maybe we'll see, people pulled back into the jobs market.
Yeah, and in that sort of that precarity within the British system, you've also got a lot of quite precarious debt, right? I mean, you have large numbers of people who have borrowed lots of money when it was cheap for not very long periods of time. I think the average car finance deal is 3 years, lots and lots of 2-year and 3-year and 5-year fixed rate mortgages, so that there's a lot of debt that needs to be refinanced suddenly at a much higher rate. Is that right?
Yeah, completely. And I think it's so interest rates have risen from 0.1% at the end of last year, December last year, up to 3% now. And to start with, 0.1 to 3% might not sound like much, but that's the fastest pace of Bank of England tightening since the early 1990s. 3% in a year is a lot. And even though 3% might not sound like much compared to that 5% we were used to before 2008, the difference, as you say, is that the level of debt is much, much higher. And 3% on £200,000 is more than 5% on £100,000. If debts have risen a lot, which they have, these interest rates might not sound high in historical perspective, but the burden of servicing them for a lot of people is going to be very high.
And then, so we've got a bank that has to inflict pain on the economy. We have an economy with kind of precarity built into it at various points, and then on the other side, we've got a government that next week will announce a budget in which that will include very significant tax rises and spending cuts to fill what some people describe as a fiscal black hole. In your piece, you write about some of the figures of the previous era of austerity coming back into Downing Street to go and see Jeremy Hunt, Rupert Harrison, George Osborne's former economic advisor, and Owen Osborne himself popping around for a chat. So I think do you think it's the return of austerity is inevitable?
I mean, it looks to be that's where we're heading. If you sort of step back, just the last 8 weeks or so have been utterly extraordinary. You get a budget, you get the Liz Truss mini budget, just 23rd of September. It wasn't even that long ago. It feels like a very long time ago. You've had a government that for 12 years has talked about fiscal discipline, about getting the deficit down, about reducing the ratio of debt to GDP as the most important things in economic policy. Then you suddenly sort of throw that all to the side. You get £45 billion of tax cuts, biggest tax cutting budget in 50 years, dash for growth. And now we've swung away from that, and we're heading towards, somewhere between 50 and 60 billion pounds of fiscal tightening, of austerity, of tax rises or spending cuts. What I worry is happening is we're seeing this sort of huge overcompensating for the giveaways from the Liz Truss government. We sort of swung from fiscal policy which was wildly too loose given where inflation was to fiscal policy which is almost certainly too tight without ever touching the middle.
And let's talk about that. Do you accept that description of a black hole in the country's finances?
I mean, I think black hole is unhelpful. Is an unhelpful phrase. We should be absolutely clear, right? Whatever number the Office of Budget Responsibility comes up with, which will be described as the black hole that has to be filled, is the numbers required to meet the fiscal targets that the government itself has imposed on itself. And the government can change its fiscal targets if it wants to. That's happened certainly more than 10 times over the past 15 years. Governments change them all the time. At a time that the economy is heading into recession, is almost certainly already in recession, any set of fiscal rules which tell you now is the time to be cutting spending and putting up taxes sound like a bad set of fiscal rules. And I think we should be absolutely clear that Liz Truss went for a very, very big giveaway, £45 billion of tax cuts. And the market reaction was utterly vicious. The worst reaction to a British fiscal event in 50-odd years since the mid-1970s. But I think it's really important that we try and understand why the market reaction was that vicious. And I think two things happened. To start with, investors very correctly, I think, said, OK, the Bank of England is already increasing interest rates because it thinks inflation is too high. If the government is going to cut taxes by £45 billion, then growth is going to be faster. So to bring inflation down, we need to raise interest rates by even more than we were already going to. And that was sort of stage one, straight after the mini budget. And because markets expected the Bank of England to be increasing interest rates at a faster pace, the value of government bonds fell. Fair enough. We've all learned a lot about liability-driven investment and sort of shenanigans in the gilt market over the last 6 weeks. And then something else happened. Lots of pension funds, it turns out, had not only bought UK government debt, gilts, but had borrowed money as part of their investment strategies, pledged those gilts as collateral for those loans. So when the government said we're going to give away £45 billion, an investor said, OK, that means the Bank of England is going to raise interest rates faster, and gilts fell in value. These pension funds found themselves suddenly being demanded to make cash payments because this stuff you've pledged as collateral is losing value. So to raise cash, they had to sell more gilts. And that added to more downward pressure on gilts. And that's why the Bank of England intervened in that market to prevent what it called fire sale dynamics. But I think that second part is an important part of the story because over the last month of the Bank of England intervening in that market of pension funds unwinding those borrowed money positions, a lot of that, that the structure of that market has changed. And I think what's happened is, I think it's fair to say the government lit a fire in the gilt market. But it turns out the gilt market was covered in kindling by these investment structures. Now, that kindling is now gone. So I think, if the government were to adopt a slower pace of, in economic terms, fiscal consolidation, in straightforward terms, a slower pace of tax rises and spending cuts, I don't think you'd see a market panic anywhere near as vicious as you saw in September, October. So I think it's sort of I think it is, we're in that unusual position of saying, the truth is somewhere in the middle. That yes, a £45 billion giveaway funded by borrowing probably isn't a great idea for the British economy, but £50 billion of austerity is also a bad idea. And what you really want is something in between. So I fear the government is overcompensating for sort of the Truss Kwarteng, disaster.
Yeah. So I guess you could describe it as, the public are caught in a way between two sets of rules, really, between the Bank of England's mandate to keep inflation at 2% and, the fiscal rules that the government imposes on itself. Yeah, I mean, sort of, do you think that if were both of those rules to change, and do you think it would be appropriate for both those sets of rules to change to accommodate, the new global economic circumstances?
Yeah, so I think I understand why the Bank of England is raising interest rates, given where inflation is, and I don't think interest rates will actually get now to sort of 5%. I wouldn't be surprised if they got above 4%, but I don't think they will get as high as some people think. This is the case where I'm listening to what the bank are saying. They're very keen to signal they're not going quite as high as some people expect. But that's, I understand why they're doing that. I think the rules we should be looking to change are the government's own fiscal rules. And I think it's perfectly acceptable to say the economy is contracting. Household living standards are taking a huge hit. Firms are seeing their revenue dry up and having to cut back on investment and lay people off and cancel hiring plans. And the last thing you want in those circumstances is the government to add to that pressure when it doesn't need to. And I think you can do that in a way that is credible with financial markets by saying in the medium term these are our plans, but our plans have to reflect where we are in the economic cycle, and we're not in a good place in the economic cycle. It just feels ridiculous to me that the economy is heading into recession and the Bank of England is tightening monetary policy and the government is now talking about tightening fiscal policy. It's a completely ridiculous mix of policy for an economy heading down.
You write in the piece about how during the last period of austerity, George Osborne and David Cameron kind of got away with it because they were able to provide the kind of illusory growth through very cheap debt that pushed up house prices, allowed people to cheaply buy cars that they couldn't really afford, that kind of thing. And that's not going to happen this time, is it?
Yeah, I think that's the thing. So, if you just step back and just look at the 2010s as a whole and sort of look at, what happened. I mean, economic growth was at best soggy. I think that's the polite way of putting it, weak growth compared to the decades before. Real incomes, accounting for changes in prices, were basically flat for a decade, which is something that hadn't happened since the Napoleonic Wars. People didn't get better off. And if you were to look back and say, okay, so we got soggy growth and flat incomes for households, and yet sort of the share of the vote of the Conservative Party increased at every general election over that period. Like, sort of squaring the two sounds quite hard until you remember, sort of the experience of the 1980s or the 1930s, again, decades with, in some ways, weak growth, higher unemployment, poor income growth, and a Conservative government which was consistently re-elected because, what matters in our electoral system is not overall performance, but there being a big enough potential coalition of relative economic winners who can re-elect you. And I think what explains that coalition in the 2010s is really low interest rates. If you look at the Conservative vote, some of it comes from demographic change and older people who were generally quite well protected from the impacts of austerity. But there was also a substantial chunk of working age non-retired voters voting Conservative. They were disproportionately homeowners. They were disproportionately drivers. These are the people that benefited from low interest rates. Low interest rates meant if you could get together the deposit, you could afford your house in many bits of the country. Your housing costs were lower than those of renters, and the value of your asset went up. And cheap car finance meant there's a lot more Audis and BMWs on the roads in 2019 than there were in 2009.
Yeah, and I guess sort of the more time people had to enjoy the returns on cheap borrowing, the more insulated they are from the end of cheap borrowing. But I mean, who are the groups who are most exposed to the downturn now, and what should the government be doing to protect them?
Yeah, so in terms of the rate shock, obviously, the longer you have owned, or the longer you've had a mortgage on your house for, the more house price growth you'll have seen. The higher the value of your equity will be, the lower the value of your debts relative to your asset. So it's obviously people that bought in the past 5 or 6 years really are the most exposed to this. They're going to have less equity in their house. The interesting thing is mortgage rates have, in general, fallen for about 15 years. So whether people have been on a 2-year fix or a 5-year fix, every time they've remortgaged, their borrowing costs have been the same or probably lower. What we're seeing now is sort of the first time in a decade and a half that people realise that when their fixed term deal ends, the new rate might be higher, substantially higher. For a lot of first time buyers in the late 2010s, they're going to be looking at £350 a month on their housing costs. Before you start thinking about car finance, before you start thinking about any other types of debt, and this is all at a time when energy bills have jumped, that food price inflation is at a multi-decade high. I think the squeeze is going to be really quite widespread. I think that's the big difference, I think. The big difference is what rising interest rates mean is it's just hard to see who the relative winners are this time round.
Do you think it's possible at this point to, the bank, as we said, has talked about this being a really quite a long recession, possibly the longest for a century. But do you think it's really possible now to say how long it will last and kind of what the growth out of it will look like?
I think it's hard to say how long it will last. That's the ever depressing thing, of course, as well. That, in the bank's forecasts, so once the recession is finally over, we don't sort of bounce back to the previous trend. It's this sort of sluggish, very sluggish, slow recovery. Things could get better. The war in Ukraine could end, energy prices could collapse. Maybe we get unusually warm weather for the next 6 months, and people's energy bills aren't as high as we think they're going to be. Maybe global supply chains snap back together. China abandons its zero COVID policy. All of there are upside things that would prove the bank wrong, mean the recession ended sooner. But the sad thing is they're almost all sort of out of the hands of British policymakers. We're sort of crossing our fingers and hoping for some good news somewhere in the global economy.
Talking about this as a global phenomenon, obviously, as you said, sort of quite a lot of the things affecting prices in the UK are exogenic. Not sure how you pronounce that, but sort of how different is the UK from other comparable economies? Obviously, Brexit is a factor that weighs heavily on our economy. Are other countries looking at similar depth and breadth of recession and similar recovery, or are we generally in a worse position?
Yeah. So to start with, you do have the Brexit impact, which we're now seeing more and more in terms of British export growth is lagging behind our global peers, and that was initially camouflaged by the impact of the pandemic. But now, as the pandemic sort of recedes into the backdrop, we can see our export growth is materially worse than most of our large advanced economy competitors. Now, inflation is high almost everywhere. It's at between 30 and 45-year highs in most advanced economies. Britain's not unique in high inflation, and economies are generally slowing, and central banks are generally raising interest rates. So, there's global economic problems. You don't want to overstate how much of that is British. I think what's different is a couple of things. Firstly, that Brexit impact on exports, and secondly, this wild swing in government tax and spend policy, fiscal policy, in that there are no other large so all advanced economies are suffering from their central banks increasing interest rates to bring inflation down, but there are no other large economies where we're seeing this instability in government fiscal policy and these big swings towards tightening fiscal policy even as the economy slows. So you look at sort of other forecasts from other central banks. No other central bank is predicting a recession as long as the Bank of England is. The hit to British household incomes is amongst the highest in any advanced economy. So, I'm afraid Britain is starting to look worse than our peers.
And, were a different government to take a different position on government spending, sort of, to what extent can the UK afford that? To what extent, is austerity sort of necessary to a certain extent, or can the UK afford to take on more debt?
It's a really tricky question to the extent that sort of since 2008, 2009 until really quite recently, it's been very easy to look at sort of the stance of British fiscal policy and say it's too tight. There is room for more government borrowing, more government adding to demand. Now that argument becomes harder at a time when inflation is 10% and the Bank of England is raising interest rates. We're in a different world to what we were in 2008, 2009, 2010. Now I still think actually there is room for more government support for the economy, but I think we should be realistic in a way I don't think the Truss government really were. That probably does mean the Bank of England will raise interest rates more to sort of offset some of the impact of that. The government, rather than if the government was to say we're going to spend more money on supporting households and firms over the next 6 months to 12 months, probably get higher interest rates from the Bank of England to offset the inflationary impact of that. But just because the Bank of England is raising interest rates to offset the inflationary impact doesn't mean it's not worth doing. A different mix of government spending and tax and interest rates has different distributional impacts. So, there is a role for the government spending more, even if the bank offsets it. It's a different case to the one we had in the 2010s when, inflation was generally low and Bank of England interest rates were on the floor. We are in a different macroeconomic world. But I just, the economist in me just thinks the idea that we should be raising interest rates and cutting government spending at a time of an, unprecedented hit to household incomes just strikes me as crazy. It's the kind of thing that in 20 years' time, people would look back at and say, what on earth were they thinking, tightening all of this policy as the UK headed into recession?
And surely, when we look at the situation that's been created by this long era of cheap debt, and the measures that have been taken to support the economy, which have exacerbated an already quite unequal economy. Surely, coming up to this sort of this very, very high point of inequality, surely tax is the key question, right?
Yeah, and to be honest, that is, to be fair, one of the grounds for relative optimism compared to the 2010s. In that, we are talking about a government which, like in the early 2010s, is talking about bringing down its deficit, of caring about government debt to GDP. But it does look like we are going to get a different mix of spending cuts to tax rises. If you go back to the George Osborne austerity program, was about 80% spending cuts, 20% tax rises. In the 1990s, Ken Clarke's version of this after Black Wednesday was more like 50-50. We'll see where Jeremy Hunt comes out, but it does look like they're going to be using a bit more of the tax lever relative to spending cuts. I think that's mainly because there is no fat left to trim in public services. They're already experiencing really tight squeezes because of inflation, because of wage costs. I just don't think you can repeat the level of spending cuts we had in the 2010s without the actual collapse of some public services.
Duncan, thank you so much. And if you enjoyed our conversation today, then please subscribe to the New Statesman's YouTube channel. And if you'd like to see more videos with Duncan on the economy, then there should be a link appearing above me right now.